When Robert Kiyosaki starts talking about triple-digit silver, it's never random. It happens at very specific moments in a market cycle. Right now is one of them. But here's what most people don't see. The gap between a $40 forecast and a $200 forecast isn't just about price. It's about something far more dangerous, something that's concentrating risk in ways the market hasn't seen in over a decade. And it's happening right now. In January 2026, while everyone's watching the numbers climb, the real signal isn't the price. It's the disagreement. And disagreement in silver always means one thing is coming. Welcome to Boring Currency. Now, before we go further into what's really happening beneath these forecasts, let me ask you something important. If you've been watching markets long enough to remember when silver was still considered boring, when analysts weren't throwing around $100 predictions, then you know this moment matters. Hit that subscribe button right now because what we're about to break down isn't speculation. It's structure. And structure is what separates those who survive volatile markets from those who don't. Also, drop a comment below and let us know where you're watching from. Are you in the States, Europe, Asia? We want to know where our community of serious decision makers is paying attention from. Now, let's get into it. When famous names start throwing out big silver numbers, it's never random. It happens at very specific moments in a market cycle. Right now is one of them. Robert Kiyosaki talking openly about triple-digit silver in 2026 is not happening in a vacuum. Neither are aggressive outlooks coming from analysts who were cautious just a year ago. Not just Robert Kiyosaki. Analysts and institutions are forecasting silver in 2026 with targets that range dramatically. Some see $40, others see $200. That spread tells a story most people miss. The way silver is making headlines at the start of 2026 isn't coincidence, it's timing. By mid-January 2026, the silver market already knows what it accomplished last year. The breakout is old news. The shock has worn off. What hasn't settled yet is what that breakout actually means. That's why predictions are getting louder now, not earlier. Big forecasts don't usually appear at the beginning of a move. They appear after a move forces everyone to recalibrate. Silver didn't just rise in 2025, it forced belief. A market that forces belief becomes dangerous because belief is sticky and silver is not. The danger today isn't missing upside, it's assuming the path forward will resemble the path behind. That's where people get hurt. Last year, silver was climbing out of neglect. This year, it's operating under a spotlight. That changes everything. When silver spent years trapped under old resistance, participation was selective. Now, participation is broad. Retail investors are back. Institutions have adjusted allocations. Public figures are comfortable attaching big numbers to the metal. Every one of those adds demand. Every one of those also adds fragility. This is the part most forecasts don't talk about. When a market breaks out after a decade of compression, it doesn't immediately become stable. It becomes sensitive. Silver right now is not weak. It is reactive. That reactivity is what makes bold predictions dangerous if misunderstood. The $100 or $200 price target sounds directional, but it says nothing about volatility, drawdowns, or timing. Silver doesn't move in smooth trends after explosive years. It moves in bursts, fast up, fast down, then sideways, longer than people expect. This is why January feels different from December. In December, silver was still being talked about as an event. In January, it's being treated as a baseline. That transition is subtle, but critical. Once people accept a higher price as normal, they stop managing risk the same way. They assume dips are temporary. They assume patience solves everything. Silver punishes that assumption. This reactivity opens the door to understanding the first camp. The conservative analysts projecting silver around $41 are not predicting collapse. They are modeling a market that needs to digest a 147% move. Their forecast is not bearish, it's structural. They see silver primarily as an industrial commodity that has undergone a necessary repricing. After such a violent upward move, markets don't typically surge again immediately. They consolidate, they test the new price level. They shake out the weak hands who bought the breakout out of excitement rather than conviction. The mathematics are simple. A market that has moved 147% in a year has absorbed a massive amount of new capital. That capital entered with a specific expectation, immediate continuation. When that continuation doesn't materialize on schedule, that capital gets nervous. It sells. The conservative forecast accounts for this digestion phase. It's a forecast built for risk-managed institutional capital, pension funds, sovereign wealth funds, large allocators. This capital doesn't chase momentum, it seeks stability. It enters markets that have proven they can hold a new, higher range. A $41 forecast for 2026, barely above the level silver has already achieved, is a statement that the market needs time. It's a forecast that attracts stabilizing flows, not speculative ones. This view is grounded in the reality of how industrial commodities behave. Factories that consume silver for solar panels, electronics, and electric vehicles do not operate on the same time frame as futures traders. Their demand is methodical, planned quarters in advance. They are not panic buying on dips or selling on rallies. This creates a steady baseline of demand, but it does not create the explosive emotional moves that characterize silver's financial side. The conservative case acknowledges the supply deficit, but views it as a factor that shapes the recovery from a pullback, not a force that prevents the pullback from happening in the first place. They understand that in a market as small and illiquid as silver, even structurally sound fundamentals can be overwhelmed by a temporary imbalance in positioning. A forecast of $41 is a warning that the path of least resistance after such a historic run is not straight up, but sideways, with a downward bias as excess speculation is purged. It is a call for patience, not a prediction of failure. Now contrast that with the mechanics of a $200 forecast. This is not an incremental adjustment. It is a different reality. Robert Kiyosaki's thesis, echoed by independent analysts projecting $75 to $88 as interim steps, is not about silver, the industrial metal. It is about silver, the monetary asset on the verge of remonetization. This view compresses time. It argues that the pressures building in the global financial system, currency debasement, sovereign debt crises, the breakdown of traditional reserve assets, are reaching a climax. In this scenario, silver isn't just a commodity in a deficit. It is a safe haven asset with a 5,000-year history suddenly rediscovered by a generation facing monetary uncertainty. The path to $200 is not a gentle slope. It is a series of structural breaks. The first break is the acknowledgement that the paper market for silver, the futures and ETFs that have historically suppressed the price, can no longer constrain the physical reality. When investors begin demanding physical delivery en masse, the tiny, illiquid physical market snaps. The price must rise violently to ration available supply. The second break is the velocity of money. As faith in fiat currencies erodes, capital rotates out of financial assets and into tangible assets at an accelerating pace. Silver, being more affordable and more industrial than gold, becomes the primary vehicle for the masses. This isn't about industrial demand growing 5% per year. It's about monetary demand exploding by 500% in a matter of months. This forecast attracts a completely different type of capital. It draws in fast money, leverage, and momentum chasers who are not interested in a multi-year hold. They are betting on a singularity event in the precious metal space. The mechanics are built on a premise of system failure, not system stability. It assumes that the current supply deficit is merely a prelude, a tiny crack that will be ripped open by a tsunami of financial demand. The aggressive case dismisses consolidation as irrelevant. It posits that the system is so fragile, so overloaded with debt and derivatives, that the next major geopolitical or financial shock will not cause a dip to buy, but a permanent repricing higher. The $200 target is a statement that the traditional rules of market digestion have been suspended by the scale of the underlying monetary crisis. It is a forecast of discontinuity, where the market doesn't digest, it breaks. But here's the critical detail. These two realities are not taking turns. They are colliding right now in early 2026. You have the steady, methodical engine of industrial demand on one side. Solar panel manufacturers, EV producers, data center builders, they are not reacting to daily price swings. Their consumption is programmed, locked in by multi-year contracts and production schedules. This demand is structural. It is persistent. It does not panic. On the other side, you have the reactive, emotional force of financial demand. This is the capital influenced by Robert Kiyosaki's predictions, by headlines about rate cuts, by the fear of missing out on the next leg up. This demand is volatile. It moves in surges. It buys aggressively and sells abruptly. The collision happens because both forces are acting on the same small, illiquid pool of metal at the same time. The industrial user sees a price spike and may delay a small portion of a purchase, waiting for a better price. The financial speculator sees that same price spike as confirmation of their thesis and buys more. One is playing a long game of cost averaging. The other is playing a short game of momentum capture. This creates a fundamental friction. The market is no longer anchored to a single narrative. One day, a strong industrial production report comes out, and silver trades like a commodity, rallying on the fundamentals. The next day, a weak jobs report sparks fears of aggressive Fed easing, and silver trades like a monetary hedge, rallying on currency debasement fears. The metal itself hasn't changed. The ounces in the vault haven't changed, but the reason people are buying it has fractured. This dual identity is silver's greatest strength and its greatest vulnerability. It is what gives it an explosive upside potential during periods of simultaneous economic growth and financial stress. But it is also what creates instability, not momentum, in the middle phase of a bull market. The market is trying to serve two masters with opposing time horizons and risk tolerances. The industrial user needs price stability to plan. The financial speculator thrives on price volatility to profit. This is why the current phase is so treacherous. The market is not confused. It is sorting. It is mechanically differentiating between the capital that belongs in the trade for the long haul and the capital that is just visiting. The sharp, seemingly irrational pullbacks are not a sign of a broken thesis. They are the market's way of shaking the tree, of forcing the fast, weak money to capitulate, so the structure can strengthen for the next move. The collision between the $41 worldview and the $200 worldview does not create a smooth average. It creates a zone of intense pressure where the metal's true character is revealed not through gentle appreciation, but through violent compression and release. And that brings us to the mechanics of the pressure system itself. Silver does not glide, it snaps. This isn't a flaw in the metal, it's a function of its market structure. Think of the silver market as a small, tightly wound spring. The industrial demand and the supply deficit are like a constant, slowly increasing force pressing down on that spring. For a long time, during the years of neglect, the spring could compress gradually. But after the 147% move in 2025, the spring is already heavily compressed. The financial demand, the expectations, the leveraged positioning, these are not gradual forces, they are sudden jolts. And when you apply a sudden jolt to a spring that is already under maximum load, it doesn't compress further smoothly. It either holds or it snaps violently to a new equilibrium. The numbers explain why. The entire above-ground stock of investable silver is a fraction of the value of a single large-cap tech stock. The market capitalization of the entire silver market is dwarfed by the daily trading volume in major currency pairs. This thin liquidity is the amplifier. When new money enters, even in relatively small amounts compared to other asset classes, it represents a significant percentage of the total market. This causes price to move quickly. But the same is true on the way out. When a wave of selling hits, there simply aren't enough natural buyers at every price level to absorb it smoothly. The price must fall sharply to find them. This is why silver historically moves 1.5 to 2 times the magnitude of gold in either direction. Gold's market is deeper, broader, and filled with central bank buying that acts as a stabilizing anchor. Silver has no such anchor. Its price discovery is a much more raw, unfiltered process. This characteristic does not disappear in a bull market. It intensifies. As more participants enter, convinced of the long-term story, they bring with them a wider range of exit strategies. The long-term holder will ride out a 20% drawdown. The leveraged speculator will be forced out by a 5% move against them. This creates a dangerous dynamic of positioning excess versus inventory excess. The physical inventory of silver is indeed tight in a structural deficit, but the positioning, the number of paper claims and leveraged bets on that physical metal, can become excessive very quickly. When that happens, the market is not reacting to a surplus of metal. It is reacting to a surplus of promises. The pressure builds until the weakest promises break. This is the snap. It's a clearing mechanism. It is not a reflection of deteriorating fundamentals, but of an imbalance in expectations. The pressure system is always testing the integrity of the structure. In early 2026, with forecasts scattered from $41 to $200, the system is under more strain than it has been in years. The warning is not that the spring will break permanently, but that anyone holding it needs to understand that sharp, unpredictable movements are not a sign of failure. They are the system working as designed, separating committed capital from casual speculation with brutal efficiency. So if the market is this pressurized system, reacting to a collision of realities, then the most dangerous asset you can bring to silver in 2026 is false certainty. Not optimism, not pessimism, certainty. This is where discipline must override conviction. The biggest mistake now is treating a price target, whether $41 or $200, as a guarantee. Forecasts are not roadmaps, they are stress maps. They show you where pressure is building, where expectations are clustering, and where the potential for violent disappointment is highest. The professional's edge in this environment isn't about picking the right number, it's about reading behavior. How does silver react to a Federal Reserve announcement that is slightly more hawkish than expected? Does it dip 2% and recover, or does it gap down 8% as leveraged longs are flushed out? That reaction tells you more about the underlying positioning than any analyst report. The key is flexibility. You must be willing to acknowledge that silver can be in a powerful long-term bull market and still inflict severe short-term pain. These are not contradictory facts. Believing the bull case does not immunize you from a 25% correction. In fact, in silver, those corrections are how the bull market refreshes itself by clearing out weak hands. This is why understanding silver is more valuable than believing in it. Belief is emotional. It makes you hold through a drawdown that should have been a warning to reduce risk. Understanding is analytical. It allows you to see a sharp pullback not as a failure of the thesis, but as a feature of the market's structure. Silver rewards awareness, not excitement. The terrain is uneven. It demands that you pay attention to the mechanics of the move, the volume on up days versus down days, the changes in open interest, the flow of metal out of exchange warehouses. These are the signals that matter when narratives are shouting in both directions. Your strategy should be built around the metal's volatility, not in spite of it. That means position sizing that allows you to withstand a snap without being forced to sell, and having dry powder to act when the pressure system inevitably creates opportunity out of chaos. Let's strip away the forecasts and look at the actual engines. Because beneath the collision of financial narratives, physical reality continues to operate on its own schedule. The first and most persistent engine is industrial demand. This is not speculative. Solar panel installations are not canceled because the silver price is volatile. The build-out of AI data centers, the production lines for electric vehicles, the relentless growth in advanced electronics, These are multi-year projects. They consume silver methodically. This demand provides a steady, upward-sloping floor for the market. It's the reason the conservative $41 forecast isn't a prediction of collapse. It's an acknowledgement that this industrial base will absorb metal and prevent a return to the old sub-$20 era. The second engine is the supply deficit. This is a mathematical reality. For the 5th consecutive year, global silver demand has exceeded mine supply by a significant margin, drawing down above-ground inventories. This deficit is structural. Most silver is produced as a byproduct of mining for other metals like copper, zinc, and lead. That means supply is notoriously inelastic. Even at $30 or $40 an ounce, it can take 5 to 10 years to bring a new primary silver mine into production. The deficit isn't going away in 2026. It is a constant tightening vice on available metal. The third engine is the wild card, financial and monetary demand. This is what separates a gradual grind higher from an explosive move. This demand is triggered by specific catalysts. A definitive signal from the Federal Reserve that rate cuts are accelerating. A sudden flare-up in geopolitical tensions that drives safe haven flows. A moment of clarity in the bond market where investors finally demand a higher premium for holding sovereign debt, sparking a rotation into tangible assets. These are the catalysts that can take the steady pressure from the industrial deficit and turn it into a spike. The critical point is how these factors interact with the crowded positioning we've already discussed. A positive catalyst won't necessarily cause a smooth rally. In a pressurized market, it can cause a short squeeze that launches the price vertically, only to be followed by an equally violent collapse as profit-taking erupts. A negative catalyst won't necessarily break the bull market. It might simply be the trigger for the necessary cleansing of weak leverage. What actually moves silver in 2026 is the interplay between these unchangeable physical realities and the highly changeable psychology of its participants. The fundamentals set the stage, but the timing and violence of the moves are dictated by positioning. The reality is that silver is being pulled by a slow, powerful tide of industrial consumption, while simultaneously being whipped by storms of financial sentiment. Navigating that requires you to respect both forces equally. The real value in these forecasts isn't the numbers themselves, but the stress map they create. A tightly clustered set of predictions indicates a stable, consensus-driven market. A spread this wide from $41 to $200 is a flashing red light signaling structural uncertainty. The professional doesn't ask which number is right. The professional asks where the disappointment will be most severe when reality fails to match the most extreme expectations. The widest gap is between the moderate institutional targets and the explosive public forecasts. That gap is the danger zone. It's where fast, impatient capital that bought the $200 narrative will collide with the slower, grinding reality of market digestion. Your job is not to bet on an outcome, but to observe the behavior around these pressure points. When silver reacts to news, does it confirm the aggressive timeline or the conservative one? The market's reaction is the only forecast that matters in real time. So silver's structural bull case remains intact, but the path forward is now a test of participants, not fundamentals. The choice is between being a spectator who chases headlines and a decision maker who understands pressure. If you want analysis that respects your intelligence and tracks these shifts as they happen, subscribe to Boring Currency. The winners in this market won't be the ones with the loudest predictions, but the ones with the clearest view of the structure.